So yesterday, basically, we reviewed the types of audit. We have external and internal, but we can have more other types of audit. No, maybe these are the main groups in audit, but we can have different types of audit. And now we are going to review international frameworks according to these two big groups, external and internal audit. So, for example, in external audit, if we are external auditors, we are going to use an international framework called International Audit Standards. That is a set or rules that external auditors need to follow. And these rules are mandatory for all the external auditors. So basically, in these rules are as here, as you can see in the description. This rule is a set of standards that was issued by the International Federation of Accountants, and is to do better and professional work in terms on external audit. And these rules are recognized worldwide. It means that the auditors in India use the same framework like the auditors in, I don't know, probably in Romania. So this is an international framework. Why these rules are important? Because it's a common language. Because obviously, because of the globalization, we can find probably a company that is established in a country, but probably this company has another company in another country, or maybe the holding of this company is in other country. So probably the external auditors, if they use the same standards, they can compare the work of the external auditors. And but yes, basically international audit standards are professional standards to do a professional work. And the structure of these standards is contained 36 rules called ISAs, because it's international standard audits, divided in 8 series. Basically, the thing that we can find in this international standard are topics like what are the requirements for an external auditor, how we need to do the communication with the management of the company, how determine materiality, what are the procedures that we need to review, how what are the most important things that we need to consider to apply an audit in a company. So for that reason, the division of 8 series. And yes, as I told you, they are mandatory rules, so we don't have option. I mean, we need to use these rules because these rules are mandatory. And on the other side, to rule the internal audit, we have a guidance or a set of rules. But in this case, is the International Professional Practice Framework, that this is not mandatory, but same as the international audit standards, they are an international framework. But remember, this is not mandatory. And they are important because probably the internal auditors could use this framework, international professional practice, as a guide to apply an internal audit, even when this framework is not mandatory. And in terms of the structure, is kind of different from the ISAs, because these rules, the International Professional Practices Framework, is divided in 2 main sections. The first called attribute standards focus on organization and individual performing internal audit, and the other group that is called performance standards, like how the internal auditor could apply an international practice, no? And finally, this part that is mandatory, no, this is not mandatory. It means that companies could use another framework, but this is the most famous. Now we are going to review the next topic in which we are going to see what is the audit regulatory environment. I'm going to explain the rules of professional conduct for auditors, the developments in audit, in internal and in external auditing, and we are going to evaluate statutory audit. Maybe you have heard about a statutory audit, and let's talk about this concept. But to start with this second topic, what is a regulatory audit? A compliance audit is a review of an organization adherence to regulatory guidelines set by regulatory authority that particular industry. So basically, regulatory audit is an audit that is required in a particular industry. Let's say, for example, let me think, in maybe in every company we will need a audit related to taxes. So because we are following the tax rules or the tax laws, this could be a regulatory audit because we are following, or because the company needs to comply with a specific regulation. And regulatory audit have 5 general elements. First of all is setting of a standard. So we need to identify what are the standards that we are going, or the external auditor is going to cover with, for example, tax standards, or maybe, I don't know if it's a public company, maybe the framework is created by the Securities Exchange Commission. So we need to identify what are the set of standards that we are going to follow. Then when we identify the rules, the set of rules, we need to know if the adoption in the company is presented or not. If the company is aware that each company needs to cover this set of rules. So we call this second stage formal adoption. Then we are going to review that if the company has implemented the rules in the normal operation. And then we are going to monitor the implementation. One thing is that maybe the company is aware and the company has implemented this set of standards, but other thing is that the company is following the correct steps. For that reason, we need to, as external auditors or internal, we need to monitor the compliance of the company to this set of standards. And then enforcement or procedures, that basically this last part is how we can improve this regulation. Maybe as an external auditors, we can find some gaps in the regulation. So some governments or some authorities let external auditors or even the regulated company to send some comments to enforce the rule, or maybe with this revision of the regulatory standards, we can find how the company could be could have or could do a better work related to the adoption or the implementation or the monitoring stage. No, basically the last part of the process of regulation is to see what are the things that we can do better. So for that reason, auditors always try to follow the best practices standards in conducting the audit. So keep in mind this, that a regulatory audit is following a specific set of rules that make us more professionals. So this is a regulatory audit when we are reviewing if the company is following the best practice in the world, or if the company is following the law. The accounting and why we have this regulatory audit. One of the factors that made that nowadays the industry, every kind of industry or every kind of sector requires this regulatory audit is because a lot of scandals that we have experimented in the past. For example, the financial crisis in 2009 and 2007 and 2009. This could be a very example to see how important is to have a regulatory audit. I don't know if you know something about the financial crisis, that basically this crisis started because the banks in the United States started to lend money to people that couldn't prove their incomes. And this was because in the United States, they wanted to have a better economic situation, because obviously population in the United States was very worried about the attacks that the Twin Towers suffered in 2011, I guess, and this was in 2007, no? I don't remember, but the American government wanted to improve its economy. So for that reason, American government start to give facilities to population in order to create a better environment for investment and for boosting the economy in the USA. So the banks in the USA started to lend money, and in a certain point, the banks needed liquidity, but because of the borrowers were people that cannot prove incomes, it created a bubble, and obviously it created the financial crisis, no, that we suffer in this time. And obviously, because the USA is the most powerful country, many countries were affected by this decision, by a problem that was born in the United States, but this problem touched a lot of countries because of the power of the USA. So if you want to know more about the financial crisis, you can check this link. But basically, this was one reason why a lot of jurisdiction, a lot of governments, a lot of international bodies noticed that auditors, external and internal, needed to follow stricter rules on auditing, no? Because maybe for some people, the government was responsible of the financial crisis. For other people, probably the banks were the responsible. Others says that probably the external auditors, because they didn't detect all the deficiencies that the banks had. So we can find a different perspective about who was the responsible of this financial crisis. And at this example, we can find a lot of examples, a lot of crises. For example, the crisis after the failure of the companies related to internet, that is known as the bubble.com. So this is another crisis, or maybe more local crisis. Probably, I remember, for example, in Mexico, a crisis that we have in 1994. So when we have a crisis, is an opportunity to reinforce rules and to reinforce supervision and the rules and the normativity, because we observe that maybe we are not prepared to face this crisis. So if you want to know more about the financial crisis, you can check this link. Yes, is the thing that I was saying. For some authors, for some scholars and investigators, they said that the banks was the most responsible part in the financial crisis, because even when the prudential regulation contemplated more efficient instrument, they decided to give these loans to people that didn't have how to prove that they will pay the loan. So for more of the authors, banks was responsible. For others says that maybe government, because the governments, as I told you, wanted to boost the economy, and they didn't measure the impact. So for some authors, if you review the literature related to financial crisis, most of the authors will say that government was the most important part in this financial crisis. Others says that maybe financial regulators, because they didn't notice this operation in the financial industry, and other external and internal auditors. And it's important to know that even when all this part, for me, I will say that this part, in a certain percentage, they have a part of their responsibility, no? But in the case of external and the internal auditors, we cannot find a lot of literature about the responsibility of external and internal auditors, even when I feel that they have a responsibility in this financial crisis. The thing that international bodies did with the external and internal auditors' participation is that they created a set of principles to have a better regulation. And one of these principles is specifically to external and internal auditors, how they need to act in terms of supervision and in terms of revision. This is the only thing that the international organization did related to get better practice to rule the external and internal audits. And because of the financial crisis, was created the Basel Committee of Banking Supervision. That basically, this Basel Committee banking supervision is a group of, is a team of experts in banking supervision that includes the best, the most powerful countries in the world, the G20. So this committee created this set of rules to have better practice in terms of regulation. And as I told you, they created a principle, and a specific principle related to external audit of banks. That is the principle 27. So after the financial crisis, this was one of the results that the financial crisis provide us. So this set of principles, if we review these principles are divided in 3 sections. One section is to supervisory powers and responsibilities and functions. The other segment of this principle is prudential regulation and requirements. That basically here we have all the things that the governments in each country needs to consider to protect the interest of the investors. So we can find this principle here in this section. And the third part of this principle that talk about the third-party cooperation, and specifically 27 talk about the external audit, that the external auditor needs to be more in contact not only with its client, I mean the company that they auditing. No, they need to have more contact even with the banking supervisors. So yes, this is the principle that created the Basel Committee of Banking Supervision. And it's important to know that in this principle, the principle 27, in this principle, this principle considers the concept called audit quality. But audit quality has been a term, has been a concept that has been very, very controversial, because quality is a characteristic that maybe could measure with different proxies. Maybe we can say that we have a audit with quality if the external auditor found a lot of errors, but maybe for one person this could be an audit quality, but maybe for other person audit quality it's deliver on time all the external audit reports, or maybe for others could be audit quality is when the external audit team is huge and they have a lot of knowledge of the company that this team is auditing. So basically we can have different point of view about what is audit quality, because quality is depend on the eyes of the person. This is a very subjective characteristic. So till now audit quality is not well defined, or I mean is we can define in different ways, depending on what is quality for us, or for the author, or for the person. But for example, one author, Husseinen, he said that for him, the audit quality is the capacity to detect and eradicate misstatements and manipulation in financial statement. That is not bad. This is true, but this is according to the eyes of this author, But again, quality is a very difficult concept to explain, or it's a very huge concept to explain. No, let's say that in terms of external auditor, external audit, yes, external auditor needs to detect all the errors and all the manipulations in order to provide a financial statements that reflect the economic situation, the economical situation in the company. And other authors, for example, they created a kind of diagram to understand what is audit quality. In this case, the framework of audit quality implies context, inputs, outputs, and interactions. But what is each part? For example, inputs consider all the values and ethics, attitudes, and knowledge and experience of auditors. So it means that inputs are all these professional characteristics that the external auditor needs to have in order to have an audit quality. So we need to have an external auditor that counts with all these characteristics to have an audit quality. Outputs, that is the context, including legislative requirements. So probably outputs are all these external factors that could impact in the audit. Maybe we have a very strong or a very intelligent framework, and this framework or this regulation will contribute to have audit quality. Context, that this other element to have an audit quality that includes corporate governance and applicable financial reporting framework. This is very important because corporate governance, I mean, compliance, internal audits, the high levels of the organization, how they could react with the observation that the external auditors provide. So this is one of the parts of the context. Another part, if we talk about concept, is legislative and regulatory requirements and interaction among key stakeholders. No, I will say that maybe outputs and context are very similar because they consider external factors. But I feel that context consider external factors and some factors inside the company. And obviously inputs that is basically related to the characteristic of the external auditors. And then we have another element that is in the center of this diagram that are interaction, that it includes both formal and informal communication, and how this communication, I mean, how the external auditor that is here in the inputs, how the external factors that are here in outputs, and how the context could communicate each other, how the external auditor communicate, for example, with the corporate governance or with the management of the company. If the management of the company listens all the observation of the external auditor, or even how the government is creating regulation according to the necessities of the companies or according to the necessities of the country. So basically interaction are very important because it's the part that connects every element, no? And if we have a good communication between these three elements, obviously we will have an audit quality. We will reach audit quality. This is another way in which we can measure audit quality. So now that we have reviewed what is an audit quality, if you remember here in the context where we talked about the corporate governance inside the company. So one important part in the corporate governance in the organization are audit committees. So basically, audit committees are formed at least for 3 non-executive directors. Why 3 non-executive directors? Non-executives because they need to be independent. So remember, an audit committee is a committee that is going to review if the organization, if the company follow internal control in a good way. So for that reason, to have an independent eyes, the audit committees require have non-executive directors. And maybe depending on the jurisdiction, these requirements could change, but yes, basically they need to have at least 3 non-executive directors in these committees. And this committee, the main function of this committee is to review what is the scope and the results of the audit, not only external, but also internal audit. So the audit committee is going to review the scope to see if the audit is touching the most important parts of the economy or the most important or the risk areas. And yes, this is one of the duties of the audit committee. So another duty is to monitor the financial reporting processes, the internal control of the business, the internal control of the business. So this is another duties that the audit committee has. And other is that external auditor, they need to review the quality or the quality of the internal and external auditors. The audit committee needs to know if these external and internal auditors are honest professionals and that give objective points of view. So yes, basically, audit committees are in charge of these 3 duties, but they could have more than these duties. But these are the most the principal. Another thing that the audit committee needs to review, and this is the code of ethics, and this code of ethics is part of the current audited regulatory environment. So this is another element or another requirement that auditors and the audit committee needs to fill. The code of ethics, a professional accountant, and the code of ethics of an accountant is emitted by IFACT, and the code of ethics for auditor is emitted by IIA, that is the International Internal Audit, International Institute of Audit. So, but in general terms, the code of ethics for accountants or for auditor are the same. And the code of ethics contemplates 4 elements, that is integrity, if the external or internal auditor is honest. So integrity and honest are very related. Objectivity, that objectivity says that the internal or external auditor, they can't have a conflict of interest, and they cannot influence the decisions. So this is objective confidentiality, because remember that as auditors, we have the access to all information of the company. But even when an auditor has this access to the information, they need to keep in secret all the information that the company provides. So for that reason, they need to have confidentiality. This is a ethic part. And professional behavior, that external and internal auditors needs to care the profession of the accountant or the auditor. So they need to report any bad behavior, and they need to boost the profession of the auditors. Now, let's see, till here, do you have any comment or any doubt? Okay, great. So these are some of the developments in auditing. We can divide according to the century, but in 20th century, the detection of fraud was the main objective of an audit. But do you remember that at the beginning of this presentation, we discussed about if the detection of fraud was the main purpose of the audit. So at the end, I told you that fraud is not the main objective of audit. This is the result, but this is not the main objective. Now the approach has changed. But in the 20th century, fraud was the main objective, maybe because in the past companies didn't have these sophisticated internal controls. So for that reason, they don't trust a lot in the controls, and they need to review a lot of things. No, maybe nowadays an auditors need to review the internal control, and if the internal control is strong enough, they can review less papers or less samplings. So for that reason, at the beginning, the detection of fraud was the main objective, no, because in the past, this kind of culture of having an audit committee or internal control, or having a technological system, obviously they didn't exist. So for that reason, this approach has been changed according to the time, along of the time, no? Another development is the way in which the audit does the test to the company, because in the past, normally the auditor used to review all the documentation of the company, maybe not 100%, but maybe 90%, no, or almost every paper or every bookkeeping of the company. But now if we think about reviewing all the transactions that a company used to do, is impossible. Maybe because obviously the auditor never ends this audit, because the transaction of a company has increased a lot. And why the operation of a country has increased? because of the globalization. No, now we have companies that are in multiple locations. Maybe a company that is located in a country, but in different states of this country. So it would be impossible nowadays if the auditor wants to review the 100% of the company. No, so the approach of this review change. So nowadays, the thing that the auditors used to do is take some items, some representative items to review, and if they detect that everything is okay, they could say that this part or this area, maybe if the auditor is reviewing the payroll of a company, if they select some parts of the payroll, and if the auditor see that everything is okay, the auditor can conclude that payroll is well done. No, because otherwise will be impossible to review all the items and all the operation. Obviously, in the past, because we don't have we didn't have this connection that nowadays we have, the reviewing of the 100% of the items was possible, but not nowadays. So this is another development, the way in which the auditors used to prove the operation, or used to review the operation of the companies. Another development in the 20th century that is very important too, and that is related to the previous 2 points, is that the auditors become aware of the importance of effective internal control. Because if the company has a very huge or a very effective internal control, it means that most of the operation needs to pass a filter that review if all the process is following the correct steps. So we don't need to wait till the end of the process. With this internal control, we are reviewing step by step, and we are with internal control. I imagine that is like kind of filters or a kind of pauses that we need to, in which the auditor or the employees of an organization could review if everything is okay. So nowadays, auditors are more aware about the importance of internal control, and even they ask for internal control in the companies. Obviously, if a company has a huge internal control or a very solid and very powerful internal control, the auditor will review less. And if the company has a weak internal control, it would mean that the auditor needs to review more items, or they need to have a major scope in the test that the auditor applies. Another, now let's move to the 21st century. This for example, nowadays is important to consider new risk in all the industries, like for example COVID-19, in which all the companies consider working, for example, remotely. So what this change has implied, maybe the internal auditor needs to review more about the platform, the technological platform. How is that the company is protecting, for example, the data or the information? And this, I feel that this situation, the COVID-19 situation, has brought a lot of changes. For example, in this regard, no, that most of the companies are working remotely, and how the company protect the information. Or, for example, a lot of companies with this situation close the business, and now the auditor need to find what was the mistakes, or why the company closed, or why the company got a failure. So nowadays, with these audits, with the audits held in 2019, 2020, 2020, 21, we are going to find a lot of approaches, because obviously an auditor needs to be adaptable according to the situation, no? Even when we never imagined that this situation could happen, the auditor need to change maybe the approach in which the auditor is reviewing a company. Another development in terms of auditing in this century is that internal audit will be more involved in cybersecurity. So why? Because internal audit, now we use a lot platform like application, or maybe website, to buy things, to do shopping, to do banking transaction. So internal audit needs to know this technological change. So for that reason, internal audit is more involved in cybersecurity, and maybe because cybersecurity has a risk that maybe if the company doesn't have a very strong internal control in terms of cybersecurity, someone could affect the information, or could affect the transaction, and the famous hackers, for example. So internal audit needs to be more involved in these terms, in cybersecurity terms. And for example, these are some statistics that 77% of the audit departments plan to cover cybersecurity detection and prevention of audit activities over this past year, and only 53% of these departments are confident in their ability to provide assurance over this risk. So imagine, we are talking about more than 50% of the internal audit teams that are worried, that are concerned about cybersecurity. And other approach is internal audit will become more automated. It means that the companies are setting aside the manual controls, and now the companies look to more automated systems. It means that probably always we will have the risk to have a human error, but not in a automated system. So 90% of the large organization will have adopted robotic process automation. So this is an important fact that we are going to discover next year. Let's see if this percentage will be true or not, but I think that it will be true, because now the companies look for being more efficient, and are looking for have less errors, less human errors, no? So this is another development in terms of auditing. And what is a statutory audit? And a statutory audit basically is a legally required review of the financial statements and records and bookkeeping of the companies. And the purpose of an statutory audit is determine whether an organization provides a fair and accurate representation of its financial position. So basically, an statutory audit is the same as an external audit. So if we talking about a statutory audit, is because the company requires a opinion to guarantee that this company is presenting the financial statements and records and figures and financial figures in a correct way, with a correct classification, with a correct valuation. So yes, a statutory audit is equal to external audit. Maybe we can find this term statutory because this is a statutory audit is mandatory in certain areas, in certain sectors. Not all the companies needs to have a statutory audit. Maybe they could have the option to have a statutory audit, but some companies, this is not an option. This is mandatory, having a statutory audit. Let's review what are these kind of industries. For example, this is evidence, an example of a statutory audit that imagine that the government requires to all these government organization, that the country requires to government institution that provides the result about what are the things or what are the activities that these government institution have done with the tax of the people, no? And for that reason, normally the government asks for a statutory audit to review if the purpose of the task of the population used according to the purpose of the country, no? This could be an statutory audit when the government institution prove that all the resources has been applied according to the political objectives of the country. This could be a good example of a statutory audit. Another example, maybe not talking about a public organization in a private organization. Maybe we have international company that have some foreign government. So maybe we have a company that is based in the United States, but this company has relation or have some companies in Europe. So depending on the location, maybe it's the same company, but maybe the location, according to the location, the government institution or the country will ask specific requirements. Maybe the government in Europe will ask for some statutory audits to fill with the Europe regulation, no? That maybe is different in the USA, even when the company could be the same, in the same brand in different parts of the world. The regulation is different according to the location. So maybe the statutory audit that Europe requires is different from the statutory audit that the United States require. So this is another example of a statutory audit. Basically, the statutory audit is related to what are the requirements that certain government in a certain country needs or is looking for. And yes, not all companies or organization must have a statutory audit. Normally, small companies are usually exempt, except charities, because obviously charities are a specific sector that they need to show how they get the funds to maintain the charity. So small companies normally they don't require statutory audits, but there are a lot of companies and a lot of sectors and a lot of fields that requires a statutory audit. It means that an statutory audit or an external audit is mandatory. Is an obligation, because maybe is an obligation because according to the operation of the company, this will have an impact in another sector or in another in the economy. For example, let's for example, in the case of the banks or investment firms, they need to have a statutory audit, basically to protect the interest of the investors. Insurance companies, that is very similar, are banks, to protect the interest of the clients, the investor, to protect the objectives of the money that these kind of entities receive. Brokerage firms, obviously, because of the same as bank and insurance, because they have an impact in the economy and they have an impact in the general public, and the public that give the money and the public that save money in this kind of institution. And public companies, in previous models, we talk about public companies that are these companies that are looking for rich capital, and for that reason these public companies sell part of the capital to the general investors, and they need to inform this investor about the operation of the company, because at the end they have the money of these investors. So it's a way to protect the interests of the investor. So now is almost, let me check how many slides we have to finish this topic. We have 5. So let's go to the break till now to following to the topic, because I don't want to continue and then cut the topic. So let's take the break 10 minutes, and I will see you here at 6:10. to have more topics. We need to review more topics. So, okay. Okay. And what is the value of an statutory audit? The value is that external audits bring us a whole picture about the company in front of legal authorities, in front of maybe tax authorities or financial authorities, or maybe the investors. Let's see, authorities like, as we talked in previous lessons, like Securities Exchange Commission, or the Financial Conduct Authority, or for example, a tax authority. I don't know what name is according to each country, but yes, a statutory audit gives a whole picture of the company to the legal authorities. And one of the benefits is the validation of the finances of the company. And if all the bookkeeping and all the accounting records of a company is well prepared by the staff or by the employees of the company, and to validate the financial position and the profitability of the company, if the profits that the company has are well calculated and well determined. So, because at the end, with an statutory audit, we are going to have an external point of view that show us if the financial statement reflects the truth, the position, the real position of the company. And other benefit of an statutory audit is earned credibility, because there are some studies that say that the companies that provide information, for example, an audit opinion, normally normal investor believe more in this kind of company. Maybe it's a natural behavior. If we notice that a company is transparent, we will believe more in this company, because this company is transparent. This company is showing the financial position, the operation, the truth. So it is positive. It's a positive, because if the investor perceive that is a transparent company, they could invest more in these kind of companies that present the truth. And other benefit is that rectify errors. If someone is reviewing the process and the operation of a company, is an opportunity for the company to correct errors and detect deficiencies, and it's an opportunity to implement a solution or better internal controls or better process. So rectifying errors is another advantage of a statutory audit. Another benefit is that external audit reduces the fraud, because obviously if the employees in a company know that every year the company has an external audit, they are going to think more about doing something wrong, or if they are pretending to do fraud, they will need to consider that the audit is going to have an external audit. So it would be more difficult for the employees pretend to do a fraud. So it's in this way that a statutory audit prevents possible frauds. Another benefit is get an objective and independent opinion. I mean, when someone is giving us an advice and this person is not involved in the operation of the company, they could give us a very enriched opinion, no? Because it happens maybe in the real life or in the normal life, no? When someone that is not involved in the problem, they could offer better solution, or this person, maybe we have a problem, no? And maybe a friend that is not involved in the problem, they can see clearly the problem and what is the root of the problem, and he can offer solution, and he can see the positive and negative part, and this is another benefit, no? Get an objective and independent opinion. Another is fulfillment of statutory requirements, because obviously, because an external auditor or an internal audit is an expert, he has the knowledge and the experience to review. And obviously, if the company is forgetting some requirements, or if the company is not complying with some regulations, the statutory audit could say, hey, you need to comply with this framework. So probably this fulfillment of statutory requirements is very associated to get an objective and independent opinion to detect any error, some errors. And additionally, validation of internal control framework. If the controls are operating in a good way, and if we detect some gaps in internal controls, we can the statutory audit could recommend some solution in order to be more efficient, and obviously have better results. Another is comparable financial statements. What has happened in previous periods and what is happening currently, and maybe it is very helpful to compare to take decision. Maybe if we detect that maybe the previous year was better than nowadays, is the time to think what are the factors that happen to get different results, no? So an statutory audit could help us to compare, to take decision, to identify internal and internal factors to get different or similar results. And if we can compare, we can plan the future. So comparable financial statement is another benefit of the statutory audit. And other is a strengthening of the internal audit in a department, because the external audit is not only useful for to reflect financial statements according to certain regulation or certain set of rules, is also the chance to tell the internal audit, you need to review this process, or you need to prioritize this area. So it's like a external audit is a very good way to get feedback and to have a better internal control, and it helps internal audit too. Now we are going to review the topic number 3. This is a very small topic, but this is very important because in this topic, we will analyze what are the audit risk, and we have some slides with recommendation to measure and minimize the audit risk. Inherent risk. This is the first of the risks that I would like to discuss. The inherent risk is maybe the natural risk that every company has because of the operation. So inherent risk we cannot avoid. Maybe if we think in a person, no? The risk of living is maybe that he can suffer an accident, no? But this is implicit in life. So no, maybe suffer an accident, or maybe living beautiful things or bad things is a risk of living. Is the same in the companies, no? Think about, I don't know, maybe in a supermarket. The inherent risk is maybe that some consumer could steal products, no? But this is a risk that cannot avoid. This is implicit in the supermarket, because the supermarket is characterized because they offer a lot of products, and maybe the consumer could take the product that he needs, and we cannot avoid this risk. It's part of the operation of a supermarket, no? But obviously we have some measure to mitigate the inherent risk, even when that inherent risk is insert in the company, or is a natural risk of every kind of company. We can minimize it. If you think, for example, in transport sector, what will be the main risk in transport sector? Maybe crashes or collisions, but we cannot avoid this risk because it's implicit. In financial services sectors, maybe if we are reviewing investment bank. An investment bank, obviously, this bank has financial instruments that are complicated to make a correct evaluation or a correct calculation. But this is implicit because obviously an investment bank needs to have different options of investment. So the inherent risk is implicit. This is the inherent risk that is implicit. Or technology sector, cyber attacks. We cannot say, no, because I have a company related to technology, and I have a very strong internal control. It doesn't mean that this company doesn't have the risk to suffer cyber attacks. Maybe this company could mitigate or could implement some control, but this is the risk of a technology sector. Or maybe another risk in technology sector is that technology goes very fast, so they need to improve every day the technology. Think about Apple, no? If they are, if they have, for example, iPhone 13, obviously the competitor is looking for another model that offers better qualities in the advices in another phone. Sorry. So we can find a lot of risk in technology sector, but these are implicit in the operation of the company. Or let's see health sector. For example, Anna, could you tell us what would be an inherent risk in the health sector?
Sorry, doctor, just I am not fully understanding, so especially this.
Mhm. For example, what would you say that is a natural risk that is associated with the health sector? What is the risk that you cannot avoid in health
Okay.
sector?
Yeah, so like something we have malpractice insurance. This is especially for doctors, like during the procedure, maybe doctor will get some what do you call this, wrong, or and this is normal. So we have something called malpractice insurance.
Mhm.
So this is one of
Mhm.
important.
Maybe one of the risks, if I associate the example that you are telling, is maybe if the doctors don't have the knowledge enough to practice a surgery.
And no, doctor, actually, even they have, this is like mandatory. For any doctor has a surgery, should be, should has malpractice insurance, because you don't know during the surgery, maybe anything will be happen. I mean, any still even has experience.
Mhm.
Yeah, this is the thing. So this is one of
Mhm.
I think,
The
yeah,
risk of in the health sector.
yeah.
Okay, thank you. And another to give another example of inner risk in health sector, I would say that another risk that is involved in a health sector, let's think in a hospital, maybe with this situation, with COVID situation, is that maybe probably the people that is working in a hospital, they could have COVID easily. So, but this is an inherent risk because obviously the hospital needs nurseries and doctors. So even when we have this COVID situation, the doctor needs to work in the hospital. So this is an inherent risk because it's involved in the operation of in an hospital. So because it's associated to the operation of the hospital. Or maybe the risk is that maybe the patient could die, and this is a risk because obviously even when the doctor could be a very very good doctor, he cannot avoid that one person can die. So this is in inner risk, the risk that is associated with the operation of the company. Or or think about service industry in restaurants. No, maybe the food could get spoiled, so this is a risk. Or maybe the food could be in bad condition. This is an inherent risk. And if we understand what is the inherent risk, we can we have another risk, that is audit risk. That is the risk that the auditor expresses an inappropriate audit opinion. Why? Because maybe the auditor didn't review enough to have a very strong conclusion. So basically, audit risk is when the auditor gives an inappropriate opinion. Detection risk is associated with audit risk. Detection risk is when the auditor doesn't detect a risk in the company because the procedure of the auditor is not well designed. So this is a detection risk. Control risk is a risk that is not corrected. Is a control that maybe is weak, and the auditor couldn't notice that one control is weak, and obviously the auditor couldn't correct it. So this is another risk, control risk. Legal risk maybe is the possibility to being sanctioned by an authority. If if a company that is involved maybe in very regulated sector, the legal risk will increase. This is legal risk. And operational risk is what will happen if a company, as an example, if all the companies don't have employees, if one day the employees decided don't go to work, this is an operational risk, because obviously the operation of the company, if one day the employees decided won't go to work, this will affect the operation of the company. Or for example, frauds, no, this is an operational risk, or accident or disasters. I remember that one day I was auditing a bank, and this bank was very close to a volcano. So they consider the volcano operational risk, because obviously if in a certain point something happened with the volcano, this volcano, the eruption of the volcano will affect the operation of this bank. Probably we never think about how the volcano is a risk for this bank. Maybe the volcano is not associated with the operation of the bank or with the core of the bank, because the bank was located very close to volcano. The volcano was a very huge operational risk for the bank, because in case of an eruption, the operation of the bank will be stopped. And we have this kind of different, and we have more risks, no? But for example, reputational risk, or a lot of risk, or market risk, probably. And but how the auditor could reduce risk with internal controls, and evaluating internal controls, and if the internal control of the company are working correctly. So this is the way in which the auditor, or in which the company could minimize the risk, or could mitigate it. And the auditor also could reduce the risk. Remember the audit risk that is associated to giving a wrong opinion. So the auditor could mitigate this audit risk, planning in a proper manner audit procedures. And additional, they need to allocate a specific team according to the profile of the team. Maybe if the company is very big, they need a very big audit team. So why? Because obviously the company has a lot of operation, and the audit team needs to be according to the size of the company. So this is another factor that could minimize the audit risk. If remember, audit risk is associated to give an incorrect opinion about if the financial statement of the company are reflecting the economic situation of the company. Other is allocate the staff according to the size, the necessities of the company that has been auditing. Another is monitoring and supervision. So the auditor, the leader of the audit, needs to supervise all the tasks of the staff in the audit team. Other measure to minimize audit risk is documenting, because all the the audit needs to give an evidence how we can prove our conclusion with evidence, with documentation. Also, the auditor needs to review other audit teams, maybe internal audit teams, or maybe the external auditors of a firm, the same firm that is located in different countries. Maybe he can review the work of the audit team, the external audit team that is in another country, auditing the same company. And always the external auditor needs to have professional skepticism, that is, don't trust in all the things that he can see. All the time he needs to investigate, and he needs to apply tests and proofs and methods. So this is professional skepticism, when the auditor doesn't believe in everything that the management of the company says. And this, I like this table because this is a table that could help us to know what would be the audit procedure. For example, if we have in the first column we have the level of audit, and if we have a high risk, if we notice that is an industry very risky, maybe I don't know, maybe an investment bank with this sophisticated financial instrument, and we detect that the risk is low, the control risk, because the company has a very good controls, is low, and detection risk is high, the audit procedures will low. Or we can measure, this table is very useful, or let's see, for example, low, the risk of the company that external auditor is auditing is low, and inner risk is low, the control risk is low. It means the company doesn't have a strong internal controls. The detection risk will be medium, and the audit procedures will be medium. So this is a guidance to know what is the level of revision or the procedures and the evidence required by the auditor to give an opinion. So this is the level of evidence that the auditor need to collect according to the risk of the company. And a last one, finally, this is the last topic in which we are going to see the process and techniques in audit. And we are going to evaluate the impact of the legal and professional requirements of the performance of an audit. Evidence are very important to the auditor to form an opinion. As I told you, all the procedures, all the conclusions of the auditor needs to have evidence, and this evidence needs to be documented. And the method of collecting this evidence, the method that the auditor uses to collect this evidence, is called audit technique. We have multiple audit techniques. One of these is vouching. Vouching is when we, for example, reviewing every, let's say invoice, no? If we detect that maybe if we are reviewing the area of income, and if we review every income of the company, if we review income, the paper, the physical paper, this is vouching. Or maybe it could be happen with expenses, no? If we are reviewing the expenses area in the financial statements, we will say if we review, for example, the expense related to oil or fuel, or maybe the expenses related to electricity, or the expenses related to the payroll, And if we review the document, this technique is called vouching. Another technique that the auditor used to collect evidence is confirmation. For example, the external auditor write a letter in which the auditor asks to, for example, to the bank, please, bank, give me what is the amount of money that the company has in this bank account. And normally the banks reply this letter, and this is the evidence of the auditor, in which the auditor can guarantee if the amount that the banks has confirmed is the same that the company has registered in the bookkeeping or in the financial statement. So this is another technique to collect evidence, this kind of confirmation letter. We can use confirmation letter to confirm, for example, the bank's accounts or the debtors or suppliers, or I don't know, maybe we can send a letter to the lawyers of the company to know if the company has legal problems. So this is another technique to collect evidence. Other is reconciliation. Reconciliation is get two different papers from different sources and then compare. For example, if we review the bank statements and we review the bookkeeping of the company, and if we detect that the figures in the bank statement and in the bookkeeping of the company are the same, this could be another technique and another way to collect evidence. Testing, this is another way. Testing is when we have a number of items in maybe in data, and we select the most representative items to review only these items, not the 100% of the data, but at least the more representative to cover a very huge percentage of this data. This is testing. Physical examination. This happens with companies that have, for example, products. If you think in Amazon, as an example, some auditor used to go to the inventory to see if all the things that the company has registered in the financial statement in the area or inventory is the same that the company has in the stock physically. Analysis is when the auditor consider external factors to get a result. For example, some companies has a very heavy season now in this period in December because of Christmas, because of this kind of celebration. So if the auditor analyze this situation, this external situation, they could say, okay, I am going to see an increase maybe in the incomes in the month of December, because I'm considered that in December is a heavy season for this kind of this kind of company, this kind of industry, and it makes sense. So this is analysis when the auditor consider external factors to get a conclusion. Example, this heavy season of Christmas. And scanning is when the auditor is scan a data, and maybe he can see a very strange number. Maybe if the sales of the company are around 1 million, and suddenly the auditor can see a sale of 3 million, maybe this could be an alarm. So basically the scanning is review and find these items that are not usual. A flow chart is when the auditor is following the procedure, and the auditor determines that each gap show the truth. And maybe the procedure contemplates 5 stages, and the auditor could say, okay, first stage is well done, second is well done. Is when the audit process is by section, reviewing step by step of one process. An observation is when the auditor go with the employees of the company and ask for explain what is a procedure. Normally, observation, we use observation when we are reviewing controls. Who is the person that do this thing? What is the person that used to do this other thing? And what are the key position that make that the process continues? And to finish, audit process. And we review audit techniques, and we have audit process too. Audit process I divided in 4. The first process is planning, then fieldwork, then audit report, and follow up and review. In the planning is when the auditor notify when the auditor start to get knowledge about the company. What are the regulations? What is the core of the company? What are the reports that the auditor needs to deliver to the company? So for that reason, the external auditor prepares an announcement letter that this letter considers the scope of the audit, the kind of reports that the auditor is going to deliver, the fees that the audit firm is going to charge. And when the announcement letter is signed off for the external auditor and for the client, the auditor could start his work. And a preliminary survey and questionnaire is basically the knowledge of the company and the knowledge of the main risk of the company. Then the fieldwork is the part in which the auditor applies all the revision, is the process in which the auditor use the techniques that we review: vouching, testing, analyzing, confirmation. This is like when the auditor is doing his work. And then audit report, that we can divide this report in a draft and the final version of the report. A draft is when the auditor present the issues that he found in the audit after applying all the techniques, all the audit techniques, and he invites to the company to correct all the mistakes or all the deficiencies that the auditor detected. And if the company change, or if the company correct the mistakes, the auditor prepare the report accordingly to the correction of the mistakes. But in some companies they decide don't correct the errors or the mistakes, so this will be reflected in the final version of the report, obviously with an opinion that is not positive. And then is follow-up review, that is the review and the report. The client see what are the deficiencies, and the report is when the auditor give the report or the reports that he wrote in the announcement letter. No, is when the auditor deliver the reports written in the initial letter. And and in this part, and in review, follow up and review is when the management of the company have all the observation that the auditor detected, and is the time for the management of the company to create a plan for the next year, consider all the observation and all the recommendation that the external auditor could discover during the audit process. So yes, we finish the class